Welcome back to another episode of Sugar Mama's Fireplay, the podcast where we ignite your financial independence, your retire early strategies, and empower you to live a life on your own terms. I am your host, passionate financial planner, Canna Campbell, and today we are talking about one of my all-time favorite investment vehicles that are actually fueling my FIRE goals, and that is listed investment companies, also known as LICs. These long-term passive income gems have been instrumental in my own FIRE journey as I successfully, and I say that proudly, not smugly, work towards building a long-term growing passive income stream of $200,000 a year. Now, if you've been following this show for a while, hopefully you've heard my previous episode where I share with you exactly the sources, how I'm tracking, and of course, what I have coming up to help make sure that I am on track with my goals, if not hopefully smashing my goals and exceeding them. So today though, I really want to share with you this particular topic around listed investment companies because they could be a really powerful addition to your existing portfolio if you are part of the FIRE movement. And of course, you have a long-term investment time frame and you understand what your risk profile is, particularly if you have a long-term investment time frame and you know and understand your risk profile, which is typically around growth to high growth for this particular type of asset class. Now, on that note of risks and asset class, I need to remind you of my general advice warning. Because I'm going to be really diving deep into this particular topic, listed investment companies, which is obviously a financial product, I need to remind you that I'm not recommending this particular asset or assets. And I will be listing some examples of listed investment companies, some of which I have personally invested in, both in my private share portfolio and the $1,000 project portfolio. So please know that just because I'm talking about these particular assets, I'm not recommended that you necessarily go and invest them. You've got to go and get professional advice from a financial planner. And of course, for those of you who are actually running your own financial strategies and you think, well, I don't want to see a financial planner, can I really encourage you to go and do a risk profile, do your own research and work out the right percentage or the right split as to what money you want to potentially include with listed investment companies in your investment portfolio. But again, a reminder, these are long-term investment vehicles and typically for growth to high growth investors. So think about that blend. I would never recommend someone puts all their eggs in one basket. All right, now that I've got that important compliance disclosure out of the way, let's get started. All right, first of all, what exactly are LICs, listed investment companies? So, all right, let's set this up clearly the right way the first time because there's a lot of misconception about what LICs really are and how they differ from ETFs and how they fit into, the FIRE strategy and of course your long-term goals. So I'm going to use an analogy. I love a good analogy. So imagine you're at a busy supermarket and there are countless aisles and sections and different types of produce spread across this shopping supermarket. And you've got to navigate this particular supermarket that you're maybe new to, you've never been to this particular one before. Grab a trolley or a shopping basket and go and find all of those items on your shopping list as you go from aisle to aisle. And then you've got to actually go and buy and pay for each one individually. Now, of course, this is going to take time. It's obviously going to be confusing trying to locate everything and all the different aisles and all the different sections and of all the different, levels of all the shelves and all the different heights and levels that you find items scattered across. Now, of course, as you're going up and down the aisles, you run the risk that you might forget something on your list or you actually might miss out on some really great weekly specials, miss out on those fabulous bargains that were hidden in the corner or, there were too many people in the supermarket and they were blocking the sign for you to see, what particular meats or breads were, slash that week or that particular time of the day. Now, that particular shopping technique, buying things individually, is very much akin to buying individual stocks. However, when you're using LICs, listed investment companies, it is literally like turning up to the supermarket, walking through the door, and then instead of having to go up and down all the different aisles, working through your list of items, you just grab one of the pre-packed shopping trolleys with all the key ingredients and produce that you need in order to be able to make and create a healthy, balanced, nutritional meal for the next few weeks. And they've done all the picking for you, and they've also included all the great specials that they found in all the different aisles, hidden away behind the crowds. Now, because all that convenience has been packaged up for you, and it is an efficient choice, you are going to have to pay a small fee, but a fee for this service, for this value add in your life. But when you think about all the hard work that is done for you, all the decisions that have been made, and the time that you get back, you can actually see that buying that or grabbing that pre-packed shopping trolley is actually great value for money. And you really appreciate it because you can simply grab it, pay for it in one big transaction, and then walk out the door, continuing on with your day. That is essentially what a listed investment company is, and to a certain degree, obviously, exchange traded funds. So think of your LIC as that pre-packaged shopping trolley, and it's filled with healthy, nutritious food that's been picked out for you by, say, a dietitian, a nutritionist, a fitness expert, someone who's really sort of considered what is the best ingredients and minerals and nutrients to build a really healthy body for great longevity. There is your LIC. Now, obviously, your LIC isn't filled with food. Your listed investment company investment has businesses, but a great mix of different diversified businesses that have actually been handpicked by fund managers with a huge amount of experience over the long term, and success, consistent success. Now, if you want to invest it in a LIC, you normally need to do this like you were buying shares. So you'd need like a ComSec account or a Moomoo account or a CMC account or a NAB trade account, like an online share trading account. Because when you invest in LICs, you buy shares like you would buy, normal shares in any other company on the ASX. And of course, some examples of listed investment companies in Australia are Whitefield, Argo, Soul Pattinson, and of course, AFI. Now, as I list those, again, reminder, I'm not giving you product advice here whatsoever or investment advice. Use this as a start. Use this as a guide to start your own research. And of course, make sure you do your research before you actually make any major investments, because I need you to see and understand the benefits of LICs so that you can actually work out whether LICs are actually right for you and your financial goals, or perhaps after listening to this episode, you might think, actually, no, LICs are definitely not for me. Because as I said, these are long-term buy and hold investments, which are really for long-term investors that are trying to build up a passive income stream, which I'll explain in a moment. So now I want to talk to you about the key benefits that come with, using a listed investment company in your portfolio. And for full disclosure, yes, I have listed investment companies in the $1,000 project portfolio, my own private share portfolio, and actually in my superannuation account. So let's now explore the different reasons, or the compelling reasons, I'd say, why listed investment companies can be a really powerful tool for you and your own FIRE goals. So the first one is obviously the immediate diversification. Diversification is the cornerstone of risk management when it comes to investing. Instead of putting all your eggs in one basket, listed investment companies spread all those investments across various businesses, industries, sectors, and sometimes even different countries. Now, what this does is it helps reduce the impact of any single underperforming stock or asset in your overall investment portfolio. So, for example, some listed investment companies give you exposure to Australian shares, maybe some international shares, emerging markets, or particular sectors that are quite niche and typically challenging to actually access. So another way to understand this is you've got $1,000 to invest. And if you go and try and invest that $1,000, obviously ignoring for a second micro investing platforms, and you're buying in parcels of, say, $500, that $1,000 is really not diversified because you can only pick 2 companies that you're going to invest in. So there's a huge amount of risk in that investment portfolio. And when you decide instead to maybe look at a listed investment company, you are potentially, buying up to 160 different companies in that one simple transaction of $1,000. For example, Whitefield, if you look on their website, you can see that they actually invest in around about 160 different businesses spread across different sectors, industries, and obviously operating in having exposure into other countries as well. So there is immediate diversification. You're not putting all your eggs in one basket. Of course, those decisions are outsourced, but I'll come to that in a second. The second benefit is accessing professional management, someone who's making those decisions for you. So navigating yourself the investment landscape can be daunting. I'm a financial planner with over 20-something years experience. I find it tough and overwhelming. The listed investment companies give you the great advantage of having seasoned professionals manage your whole entire portfolio. But the difference is also here, they actually have historical returns to show you how they have typically performed and how consistent they are over the long run. And you actually can see how they've handled stressful times in history and how they've sort of bounced back or recovered, or how long it's taken for them to recover. So they're actually making all of those really overwhelming investment decisions on your behalf. And these experts, they analyze, market trends, they have access to company performances, they even have direct access to the CFOs and managing directors and owners of these businesses. So they are literally like sitting almost in the office of these businesses, working out whether they're great investments for you and all the other shareholders, or perhaps not. And of course, they're making all of those strategic choices and decisions, which comes to like making the most of your money, optimizing returns, taking up rights, buybacks, all those sorts of things that happen in the market, paying dividends and so forth, and allowing you to benefit from their expertise without the need to have to constantly monitor the markets continuously when you're trying to do this yourself. So you get a lot of time back for yourself, and you take a lot of stress and pressure off your shoulders when you use a listed investment company. And I will say is obviously the same benefit that comes with managed funds and exchange traded funds. Now, this is a really big one, and this is where we start to sort of see the key differences. And I think, in my personal opinion, how LICs are actually more superior than exchange traded funds. Okay, so unlike exchange traded funds, ETFs, listed investment companies operate as companies. This tax structure actually allows them to pay dividends with franking credits, and reflecting that the tax has already been paid at the corporate level. So for investors, this means potentially receiving tax-effective income, as those franking credits can actually help offset personal income tax liabilities. Also, some listed investment companies, typically the older ones, like for example, Whitefield is over 100 years old, they may have particular tax advantages because they can sometimes distribute dividends sourced from capital gains, which would then mean that as a shareholder, you're potentially eligible for the capital gains tax discounts, which actually adds a whole other level to the tax efficiency of a listed investment company. So you need to understand ETFs and LICs are similar, but the key difference between the two, an ETF is an exchange traded fund, and it typically uses a trust structure, where a listed investment company uses a company structure. It can be a lot more flexible when it comes to tax and, of course, the tax efficiency. So that is essentially the big difference between the two. And as I said, I feel like for a lot of people who get this, they'll actually realize it is a listed investment company. When it comes to that, just one key benefit instantly makes it far more superior and efficient. The fourth benefit, I would say, to a listed investment company is the administrative simplicity. Managing a portfolio of numerous individual stocks can be extremely onerous, burdensome, especially when it comes to the end of the financial year, because each stock that you buy generates statements typically twice a year, which means you have a mountain of paperwork to go through and to get your accountant to go through, which may end up being quite expensive. So, for example, if you have say 20 or say 30 different individual stocks in your share portfolio, that means you've got 60 statements to go through at the end of each financial year. Whereas in contrast, when you're investing through a listed investment company, or even like obviously a managed fund or an ETF, this is all consolidated for you, as all your holdings are detailed within the one or actually two statements that are paid during that financial year. So it means that your record keeping is so much more streamlined and efficient. It means you've also got a really great sense of clarity when it comes to your investment portfolio and where it's at, how much it's paid. It's just so much easier to document and understand how you're actually progressing, which is really important if you're part of the FIRE movement. So this efficiency of knowing that you're investing in, say, 160 different companies, but yet you only need to get 2 statements a year, which detail obviously the income, the franking credits, how many units you've got, is going to give you, again, back so much time and allow you to see where you're progressing with your financial goals and reducing those administrative headaches, particularly if you're using a dividend reinvestment plan and have been using one for quite some time. The next benefit to a listed investment company, and to really understand how powerful these are, is, and this is probably, I would say, the biggest, if not tying with the point number 3 being the efficiency through a company tax structure, and that is consistent growing dividends. Many listed investment companies have a track record of providing consistent dividend payments, with some actually demonstrating a history of growing dividends over time. Now, this can be particularly appealing for passive income investors like myself, who really are trying to build long-term passive income stream in a stable, consistent way. This obviously includes the FIRE members, but it also includes retirees, people who need to know that they're going to get their dividends. It's going to be hopefully bigger than last year, and it's going to continue on fueling their financial independence. Now, with a listed investment company, they actually use a close-end structure, which allows the listed investment company to actually retain earnings during profitable periods, which can then be used to maintain dividend payments during less favorable market conditions. Now, if that doesn't make sense, let me just explain. It's like the company has a bucket, and the bucket is just continuously being, filled with water each year. But every now and again, there's a lot of water, there's a downpour, and that bucket is full. It's got more water in it than what it usually would. Because it's got that flexibility of a company tax structure, the person managing that bucket of water can decide how they're going to distribute that money to the shareholders, the people who are holding their cups ready to have them filled up. And because they may know that, for example, there might be a drought or there might be some flooding coming up, they know in advance to how to distribute that water so that everyone is consistently getting their hydration needs. Hopefully this analogy is making sense. So what it essentially does, it allows the fund manager behind the listed investment company to take a really proactive, mindful and intentional way in paying consistent income out via dividends, but in a smooth way. One of the things you'll notice if you look at the historical returns of, say, an exchange-traded fund is the income being paid can be very lumpy and chunky. And that's because the fund manager uses a trust structure and has had to pay capital gains out or special dividends out for each financial year because that's what the law says you have to do. So that can then obviously then dramatically impact the share price or the unit price of that ETF. This is something that is not desirable, and it can also create havoc for the individual shareholders because they're getting all these capital gains taxes and large income payment dumped on them, which doesn't necessarily work for them from a timing point of view. And then that often means that the following year, the dividends aren't going to be as strong. So this is what I'm trying to explain to you. A listed investment company, as I said, allows them to just retain earnings if and when they want. They don't have to always pay them out. They can decide, okay, well, this year we'll pay out this much, and the following year we'll actually pay out this much more or this much less. They have that complete, absolute control. The trust fund, like an ETF, doesn't have that flexibility at all. And, as I said, when capital gains tax is triggered, they've got to be paid out. They can't hold on and retain those earnings. And I highly recommend going and listening to my podcast episode with Angus Glusky, who runs Whitefield, because he talks about this in more detail and how incredibly powerful it is. Now, as you can see, I love listed investment companies. Now, the next benefit to a listed investment company is that transparency through the net tangible assets. This is, again, really helpful. And once you've listened to this, you'll be onto these websites in a hot second. So a listed investment company has to regularly report their net tangible assets, which is where they provide their investors the insights as to, how the underlying value of the portfolio is actually sitting at. Now, you'll be happy to hear this is actually really easily found, and you find it simply on the listed investment company's website. So last night I jumped on the Whitefield website and I had a look at what their net tangible asset was. And it was the 28th of February, I think, 2025, it was actually valued at $6.31. And I then jumped on and had a look at what the share price currently is. It's $5.32. Now, by comparing the net tangible asset, that is $6.31, against the listed investment company's share price, which is currently $5.32, investors like myself and you can quickly identify if there's a potential buying opportunity with this particular listed investment shares when the net tangible asset is bigger than the listed investment company's share price. That is, the listed investment company shares are actually trading at a discount to the net tangible assets. Or vice versa, if the listed investment company's share price is actually higher than the net tangible asset, it means they're potentially going to be paying for that share at a premium, which of course we want to try and avoid. So this transparency is really valuable and actually helps us, feel more confident in our investment decisions, and means that we're making educated, informed decisions and thinking about our long-term goals and where we really want to go. You would be a fool to just go in and buy a listed investment company without checking the company's website, obviously doing all your research, but seeing what the net tangible asset is. And literally, it's on the homepage. You can't miss it. I'll even go and link some of these in the podcast notes if it makes it easier for you. And then finally, the other benefit to having a listed investment company in your portfolio or part of your overall portfolio is LICs, as I said, have close-ended structures, meaning that they have like a fixed pool of capital and are not subject to investors' redemptions or even demands. So let me quickly explain this. When it's closed-ended, it means they aren't issuing a continuous supply of shares in the business. So it's like going to a shop that's not producing any more stock. You can only buy what's available. They're not going to be making more and filling the shelves again. So you need to, buy for the long run, and you need to not buy exactly what you need. So when it comes to actually buying shares in the listed investment company, you can only actually buy those shares when they're available because another shareholder is selling theirs. Now, what this does for the business is really important that you understand. It actually helps create a stability of cash flow for the underlying fund manager behind the listed investment company. And because of that, it means that they can just focus on the long-term investment strategies without the pressure of having to meet short-term liquidity demands. Now, because of this strict requirement being close-ended, most of the shareholders in the listed investment companies are all in it for the long run, for that long run love of growth and income. And it's very much akin to planting a fruit tree and allowing it to grow undisturbed, but obviously making sure it's got sunlight and not disturbed by pests and weeds, and doesn't obviously get too much water, but just letting it do its thing, rather than constantly uprooting it and checking its progress and then questioning why it hasn't produced any fruit yet. If you can think of a listed investment company as that fruit tree, leave it alone, let it grow, let it create those deep roots first before it starts to sprout and become that fruit tree. And that fruit tree will then eventually give you this abundant supply of fabulous, nutritious, delicious fruit, which you can use for many, many years to come by simply picking the fruit and letting another season come and it produces more fruit again. You're not digging the whole fruit tree out and getting rid of it and starting all over again from scratch. You let it do its thing. And that does require self-control and, of course, a lot of patience, but definitely patience that is well worthwhile having, doing, and following. And of course, the flow-on benefits from this is it helps keeps those investment fees, the MERs, down, makes them competitive, makes them low, means that you're getting even better value for money. Now, of course, it wouldn't be fair or ethical for me to just only talk about how fabulous listed investment companies are without talking about the limitations or frustrations even of LICs. So let me just quickly run you through the downsides. Look, there aren't many in my opinion, but I still need to do the right thing and make sure that you're aware, because this is all about financial education. So, all right, these are the drawbacks or potential drawbacks that you need to understand if you're trying to build a balanced investment portfolio. The first being the market price versus the net tangible assets. So listed investment company shares can trade at a premium or a discount to the NTA, which we just discussed. And buying at a premium obviously means that you're paying more than the underlying assets are worth, which you obviously want to avoid. And of course, the flip side of that is purchasing them at a discount that might indicate that they're undervalued on the share market. However, when you're looking at those 2 points of comparison, there is absolutely no guarantee that the discount will close. That is, for example, with Whitefield, that the share price is going to bounce back up to $6.31 or even higher. Nothing is ever guaranteed when it comes to investing. And of course, that gap could widen further. So, the net tangible asset right now of Whitefield is $6.31, currently trading at $5.32. that could go lower. That share price could actually drop below $5 even. These are real risks that you need to understand before you go and invest. The second downside, which obviously I don't think is a downside if you're coming from a place of scarcity, if you think this, is the management fees. Obviously, fund managers don't work for free. Listed investment companies charge management fees for their professional services, for the advice they deliver, what they go and do, and of course the value that they add. Now, whilst these fees obviously they compensate for that expert management, they can obviously vary between listed investment company and listed investment company. And of course, the more fees you're paying, it's going to impact the returns. So you've got to sort of, when you're doing your research, it's really important that you assess whether the fees are justified by that listed investment company and the performance they've delivered and the risks they're taking. And of course, if they align to your long-term financial goals. Now, when I was on the Whitefield website last night, I had a quick look at what their current MER is, and I actually remember interviewing Angus Glusky from Whitefield, and their fund manager fee was around about 32 basis points. Anyway, to my delight, and hopefully your delight, you can see that the MER has now dropped to 0.26% per annum. So if you think about $100,000 invested in Whitefield, again, not investment advice, this is an example, you're only paying $260 a year for them to invest that money for you, make all those decisions, and do all the statements for you when it comes to tax time. I mean, that means that your fund manager is almost working for a couple of cents a minute. That's slave labor. That is, in my mind, excellent value for money, rather than you having to invest that $100,000 yourself and think about all the time, knowing what stock to buy and when that stock to buy, whether it's good value or not, which offers to take up, if they have a buyback or you can get some bonus shares. These are all the decisions are done by a fund manager, and they're charging you $260 a year, which, might I add, is also tax deductible. So to me, yes, fund managers are a part of the game, and they're well worth it in most situations, but you need to understand the cost of it and how it impacts your return. Next is liquidity. Now, this is one that you must understand. Some listed investment companies, particularly the smaller ones, which I'm not really comfortable with personally, but you always do your research because there are some good ones out there, they may have a lower trading volume, leading to liquidity issues, which means if you need to sell, you can't necessarily offload your stocks, or you have to offload them at a really low price, which is not ideal. So this makes it really challenging to buy, but also to sell shares without it actually impacting the price. And this is particularly relevant during really volatile market conditions like we're experiencing right now. So before you go and invest in a listed investment company, make sure you can see that there is lots of liquidity before you invest, because you may get caught out if you need to sell, or if you want to try and buy back more and you're stuck because there's no one else selling their shares, their stock in the company. And then finally, performance variability. Like all investments and the whole world of investing in different asset classes and different stocks and industries, nothing performs equally. There is a negative correlation between the share market, fixed interest, the US market, the Australian market, the Asian market. They're not perfectly in sync with each other. They don't all perform well at the same time, or it's very rare that they do. And the success of a listed investment company is exactly the same. It obviously depends on the fund manager's skill and their investment strategy. And past performance is never indicative of the future performance. So whilst you might go and look at how they performed over the last couple of years, know that that is not actually an accurate reflection of where they're necessarily going in the future. And I will say, when you do look at historical returns, please don't just look at the last couple of years. Try and look at the 10, 15, 20 years worth of returns, those historical returns, to get a much clearer picture as to how they perform consistently over time. So do your research, look at that track record, and of course, look at the management team and making sure that they've been around for a really long time, and that they're consistently there for the business and not jumping from fund manager to fund manager, which can obviously be a risk in this particular market right now. Now, in summary, listed investment companies, as you can now hear, can be really valuable in your investment portfolio, and in that, I guess, toolkit that you have. They give you the diversification, you access amazing professional management, the tax efficiency, the growing passive income, the admin ease, transparency of the net tangible assets on the website, and of course that long-term focus of building capital growth and growing passive income streams through dividends, ideally fully franked dividends. However, at the end of the day, it is vital to actually weigh these benefits against your obviously potential drawbacks, such as those deviations and management fees and liquidity issues, and of course that performance variability. But these can be also incredibly powerful, and I'm happy to disclose I own these myself. So with any investment, as you know, due diligence is key. Look at your own financial goals. And as I said, these are for long-term financial goals. Look at your risk profile, the risk tolerance, and of course, the time frame in which you want to achieve your goals, because a listed investment company is for the long run, 10 years, if not longer. And my goal with my listed investment company is to never actually sell it, but to eventually build up enough passive income through dividends so that I never sell those shares. I just get my dividend checks or deposits, twice a year that cover my living expenses for the next 6 months or beyond. And then once that runs out, I get another dividend paid 6 months after that. So this is a continuous flow of water. That bucket of water analogy just continues on filling up my cup every time it's about to run dry or it's looking like it's a bit lower. I get, that dividend comes in perfect timing. Now, of course, if this is something of serious interest to you, I will always recommend you go and speak to a financial planner and you speak to them about how it is best for you to use a listed investment company in your portfolio, but potentially blended with your other investment assets. Because you never want any regrets when it comes to building your own financial freedom and independence. All right, that is it for this episode today. Thank you so much for tuning into Sugar Mama's Fireplay. And I really hope that you've enjoyed this particular episode and you feel so much more motivated and inspired when it comes to this really powerful investment asset class for your own goals. Now, until next time, stay informed, stay empowered, and keep that financial fire burning bright. This is Sugar Mama's Fire.